Hello, everyone, and welcome to Fundamental Auditing, Chapter 2. So Chapter 2 is Auditors' Professional Rules and Responsibilities. So Chapter 2 is going to start the conversation on the types of rules that auditors have to follow, and then Chapter 3 will have more of a discussion on like the ethical responsibilities. So the standards that auditors have to follow, they're called the Generally Accepted Accounting Standards. So this provides a framework under which all auditing standards are applied. And then there's also the Canadian Auditing Standards, or CAS, which goes into details of what the responsibilities of the auditors are, how they're supposed to audit, how they're supposed to plan, supervise, and just all the rules about going through the audit. So we're going to look at CAS standards in a lot more detail. So throughout this course, we'll look at the different types of CAS standards there are. So there's just standards on everything, like what is the auditor's responsibility around fraud? What do they do if a company is in has a going concern issue? What type of reporting do they do? Do auditors do? How do we test? What type of evidence do we find? All those rules of how you do an audit is in the CAS standards. So in class, we're going to do a lot of looking up the CAS standards and trying to interpret the rules. So if you're going to be doing your CPA exam, you will get access to the Canadian auditing standards during your exam. So you really want to make sure that you understand those standards, because that's something that you'll be using. Okay, so throughout this course, like I said, we'll go through and I'll show you how to look up those standards. In those standards, it talks about how auditors should comply with relevant professional and ethical requirements. Specifically, auditors have to have competence, objectivity, and independence, and have due professional care. So we'll look at these in a little bit more detail. So competence means that the auditors need to have adequate technical training and proficiency. Competence is gained through education and on-the-job experience. So what you're doing now by taking this course is you're getting your technical training, getting that competence, and then when you go into the workforce and you become an auditor, then you'll be getting you'll be getting some on-the-job experience, and that's going to increase your competence. Okay, so even if there's a junior level auditor and they don't have any experience, they're going to be supervised by a higher level auditor that has more experience. So even if the junior person isn't competent, there's somebody looking over them that is. Auditors also have to be objective and independent. So when looking at a company's financial statements, auditors are expected to have an objective state of mind. They have to be unbiased, impartial. They have to be independent. There shouldn't be any like financial gain that they're going to get out of by saying that the revenue number is correct when it actually isn't correct. We'll talk about independence in a lot more detail in Chapter 3. They also have to have due professional care. So they have to be professional and observe and follow the rules of professional ethics, which we'll talk about in Chapter 3, and the GAS standards, the auditing standards, which means they need to be competent, independent. They need to exercise proper care in planning and supervising the audit. They need to understand the auditee's business and control structure, and they need to obtain enough evidence for them to make a conclusion on whether the financial statements are fairly presented. So like I said, the auditor should obtain reasonable assurance that the financial statements are free from material misstatement, whether due to error or fraud. Okay, so here, material is a word, or materiality is a word that you will have to make sure that you know it's very important in auditing, because what auditors do is they make sure that the financial statements are free of material misstatements, okay, whether they're due to fraud or error. They're not making sure that the financial statements are 100% correct. They're making sure that they're free of material errors. So what that means is when auditing, and we will discuss this more in the later chapters. When auditing, we pick a materiality amount, and anything above that material amount is what we make sure are free of error and fraud. Okay, so we don't audit every single number. We don't care about the $10 revenue or the $10 cost expense that somebody had. We care about the big numbers, the numbers that are going to make an impact in people's decisions. So something is material, or amount is material when it impacts the decisions of the financial statement users. So if there's a financial statement user who, for example, if your revenue number, let's just write this down here. Okay, so if the company's revenue number was, let's say, 900,000, a material amount in the revenue number is a number that's going to, like, if something is material, if there's a material error, that means it's a big enough number for the financial statement users to make a different decision about like whether to lend to the company or whether to invest in the company. So if there's an investor and they were looking at the financial statements and they saw revenue was 900,000, how much of an error in this revenue item would make the users of the financial statements change their mind on whether they want to invest or not. Okay, so if there was a $50,000 error, for example, and revenue was actually supposed to be 850 instead of 900, would the fact that revenue was off $50,000 make them change their mind on whether they want to invest or not? Maybe not, right? But if the error was actually a lot bigger and revenue is actually 600,000 because there's a $300,000 mistake, that's probably a material mistake that would probably change the decision of the financial statement user. So what auditors have to do is they have to figure out how much of an error or misstatement would make the financial statement users change their mind about a decision they have to make when looking at the financial statements. So is a $300,000 error enough for them to think that something is material or important enough for them to change their decision, or is a $50,000 error enough to be material? Okay, so auditors don't look at every single error. What they do, what the opinion they state, is they provide reasonable assurance. Okay, so not 100% assurance, but reasonable assurance that the financial statements are free from material misstatements. So they can say there's reasonable assurance that the financial statements are not, materially misstated by like 300,000, for example. Okay, so that's what material is. That definitely is a word that you need to know in auditing. It's very important. So if something is material, then it's going to change the decision of the financial statement users. So maybe 50,000 isn't material, but 300,000 would be. Okay, so early on in the planning process, do the auditors determine what material is, and then they'll test the revenue items over materiality, the expense items over materiality. Okay. We talked about the audit risk in chapter 1, so that there is a risk that the auditor expresses an inappropriate audit opinion. So they'll say that the financial statements are free from material misstatement when in fact they are materially misstated. So that's audit risk that we have. So the auditor needs to plan and perform the audit to reduce the audit risk. Okay, so if there's a risk that we're providing an inappropriate opinion, saying that the financial statements are free from material misstatement, but they're not, then we just have to do more work. We have to plan more properly. We have to do more work. We have to get more evidence to make sure that we don't issue a wrong opinion. So planning, so talking about planning the audit. So CAS 300 talks about what we have to do to plan an audit. So an audit program needs to be created, or like an audit plan. So we need to make an audit planning memo talking about the knowledge of the auditee's business, The risks that are involved are audit risk, materiality, like I was talking about, and we also want to discuss what type of audit procedures we're going to do so that's all part of the audit planning memo, we call it. We have to look at the timing. So the audit planning needs to begin before the client's fiscal year end. So usually the auditors will go in and do the audit after year end, but planning needs to happen well before year end. The auditor also needs to do an internal control assessment. And we will look at this a lot more in chapter 7 and 9, but basically an internal control assessment is looking at the company's like policies and procedures around accounting. So for example, does whoever's doing the bookkeeper, for example, the bookkeeper that's doing the accounting, is somebody else reviewing their work? Right. So like that's the type of, like, is there a procedure or policy in place that some supervisor or controller reviews the bookkeeper's work? So looking at what type of controls they have put in place to detect or prevent misstatements happening in the financial statements. So the auditor needs to gain an understanding of what type of controls are put there by the company for the company to make sure that their financial statements are free of errors. So the auditors need to understand the internal controls of the company. So what are the measures that they've put in place? Because that's going to affect how much of a risk there is that there's going to be misstatements in the financial statements. CAS 200 talks about getting the auditors to obtain enough evidence to justify opinions. So there needs to be sufficient evidence obtained by the auditor in order to make the opinion that the financial statements are free of material misstatement. So the evidence has to be both reliable and relevant. So reliable meaning like you can't just go to management and say, hey, is this revenue number correct? You actually have to go and find out if it actually is by looking at additional evidence. So looking at invoices, for example, you can even go and talk to the customers and say, okay, how much were you charged for whatever the service was that was provided. And you need sufficient evidence. Okay, so you need a sufficient amount of evidence in order to make the opinion that the financial statements don't have material errors in them. So it is a hard thing for auditors to figure out how much is sufficient evidence. So they just have to be positive that there are no material misstatements, and they have to be comfortable with that statement that they're making. So they need sufficient or as much evidence as possible for them to be comfortable that they're making this type of opinion. So there's two different audit opinions, and we'll talk about this more in chapter 4, but basically CAS 700 and CAS 705 talk about what type of opinion the auditor is going to present. Okay, so at the end of the audit, the auditor will give an audit report to the client, and the audit report will have their opinion on it. So CAS 700 and 705 actually gives you examples of audit opinions. So you should take a look at those CAS standards to see just to get an idea, and the textbook has this too, just to get an idea of what the audit report looks like. Okay, so there's two different opinions. There's an unmodified opinion. This is a good opinion. So this is that the auditor thinks that the financial statements are free of material misstatement, and there's nothing that they think might be wrong in the statements. Okay, so there's no reservations, nothing that they think is wrong. They think everything is good. Then there's modified opinion. So modified opinion is not so good. So the auditor either says that something is not correct, you're not doing your accounting properly, so there is a departure from like the IFRS or ASPE standards, so departure from GAAP, or there is a limitation in the scope of an audit. So what a scope limitation means is that they weren't able to get enough evidence to prove that something is free of material misstatements. We will talk about the types of opinions a little bit more in chapter 4 is all about audit opinions, but I just wanted to just kind of introduce it to show you what the end result of doing an audit is. The end result is providing an opinion. So you're providing an opinion that the financial statements are or are not free of material misstatements, either caused by error or fraud. All right, so that was chapter 2. Thank you for listening and take care.